Well, thank you for being here today, Joe. Just kind of want to start right out. Tell me, how'd you get your start in real estate? Tell me about the Inland story.
Well, the Inland story dates back to 1967, 68. There are four of us who are the founders. It's Dan Goodwin, Bob Baum, Bob Parks, and myself. And three of us went to college together, ran the fraternity together in college. And when we got out of college, and our goal, of course, was to be teachers. We went to Chicago Teachers College, which then became Illinois Teachers College, and then became Northeastern University by the time we graduated. In any event, our goal was to be an educator, and so as you know, educators are not paid as well compared to the effect they have on society. And so Dan says we should do something on the side. So we think about it, and Dan comes up with the idea, why don't we get into real estate? And none of us came from family with any money. My father was a barber, and so we all decided, well, we'll go to school to get our broker's license, and then we'll figure it out. So here's how we figured it out. Dan meets with a savings and loan guy at the time. The guy must have been 70, 75 years old. And not only did he have a real estate office, but he had the savings and loan, and he was everything. It was a one-time shot. And basically he said, if you buy these scattered lots that I have, home lots, and two flat lots of ours, I'll give you the construction loan to build the houses. Well, we knew somebody, one of our teacher friends, his brother actually built houses, so we tied in with some of his knowledge. And but the biggest thing was, how do you get the capital? Well, we went to all of our teacher friends and administrators that we knew, and we would get $250 from somebody, $350, $500. Maybe the top would be a $1,000 investment. Pool it all together and buy the lot and build a house. Well, the first one was either Bensonville or Itasca, and then we went to Arlington Heights. And in any event, we built the house, we painted it, stained it, we sold it, made a profit for the investors, a good profit. I think it was probably double their money. And then we went on to the next one and the next one, and we did a couple of two flats. And then all of a sudden, now you're into 69, and the first money crunch that we ever saw happened, meaning interest rates went to 10%, and it was hard to get a mortgage. And so we thought, well, this new construction business isn't as great as we thought. You can make money in it, but you could also get stuck. We sold our last house, and we thought, well, what do we do now? Investors still want to invest with us. What do we invest in? So we came up with the conclusion that if we could find something that we could buy, manage, and see a nice rental stream and extrapolate that rental stream and the numbers to make it look good for investors for a nice profit for them, we would do it. We decided to go into apartments. And I think the very first deal we did was a three-flat on Pine Avenue in the city of Chicago. And Dan and I negotiated with the seller, bought it, ran it. We quickly realized we can run, in fact, income properties, and so we went on from there. And now by, I'd say, the middle of the 1970s, we probably had maybe 4,000 units. We had about 40 buildings in Oak Park alone. We concentrated on the west side of the western suburbs. We then branched off into the outer suburbs, and by the end of the 70s, I think we had about 20,000 units.
And when did you guys quit teaching?
Oh, well, that's a good point. We all started teaching in either 65 or 66 or 67, and we all left education in 71 and 72 because the business got too big. I couldn't do it at recess time, and I couldn't do it at lunchtime anymore, and tell everybody I can meet you after 3:15. So we all left education. And tell you something humorous about leaving education. Yeah. There's a couple of things that you can do in business you can't do while you're a teacher. One, you can't go to the bathroom whenever you want to, but in business you can. And I could have coffee sitting at my desk. What a wonderful way to do business. And so, but one thing that education did teach us, and that was to be detailed. Not only to be detailed, but also to plan ahead. As an example, when you're a teacher, you have to know a week from now or 2 weeks from now, on that Tuesday, where are you going to be in that chapter? What are you going to be teaching at that time? And what backup do you have to illustrate what you want to teach the students? So, in any event, all of those things worked well for us. The four of us, again, went full-time. By 72, we were all full-time. And we're still together today. Everyone's still working, except it's around, 1,400, 1,500 employees. So, so now at the end of the 70s, we have a lot of apartment buildings. We have a lot of apartment complexes, mostly in the suburbs of Chicago. And in 1979, in November, the discount rate goes up 100 basis points. And all of a sudden, it stopped business in their tracks, and which started an enormous increase in interest rates to a point where by 82 or 83, the rates had gotten to be 14, 15, 16%. So what we decided to do was, well, if that's the case, and you cannot cash a seller out in an apartment building, then let's get him to hold the paper. Well, we got them to hold mortgages, second mortgages, long-term, and gave them a very low interest rate so that the property would work for our investors. And it was fine. It did. And not only that, at the same time that Reagan instituted tax reform, one of the tax reforms was to reduce the depreciable basis for real estate over a much shorter number of years. Instead of depreciating over 30 or 40 years, you could depreciate it as low as 15 years. Well, in that case, you could reduce the amount of income tax you had to pay on the income you were getting from the investment. Not only that, you had something left over to shelter your own taxable income of your salary, etc. So it became a very, very good business. And these limited partnerships worked extremely well. You get to 1986, and then another tax reform happened. Only this time, the tax reform literally shook the country, because when they did the tax reform in 1986, they went retroactive back where all of the deductions people thought they should have gotten, because that was the law, no longer were in effect. And what that did was it started an enormous decline in many, many businesses throughout the country from 1986 all the way till about 1994, 93, 94. One of them was the decline of the savings and loans, because of the loans they made on income property, where the income property no longer was worth what it was once worth. Then there was the decline of apartment occupancy throughout the country. There was a decline in construction, completely stopped. The federal government instituted, I forgot the name of the entity which controlled the sales of bad loans.
RTC.
The RTC. Thank you very much. Sounds like something you hop onto and go to work on. But the RTC was fabulous for people like you and I who might want to buy something at a real deep discount, and which we did. But during that time, something else happened too. There was a couple of things with Inland. One of them was the fact that we had about 300 partnerships by that time. I would say the bottom 10 or 15% was not worth what the investors paid for. Had declined that much. And we were not going to allow our investors to lose money. So for almost a year, we all got together and tried to figure out what's a way to be able to get them out of that deal. So we came up with a plan, and that was to buy something that was better than what they had and tax exchange them into it. And it took us 8 months, but one of my employees, Lou Quillisi, finally gets a meeting with Walmart. And so he and I fly out to Bentonville, Arkansas. And I didn't even know what a Walmart was in 1988, 89, because none of them were in the Chicagoland area. And so we met with Walmart, and Walmart liked us. We both had the same accounting firms, and they checked us out, and they said, good people. And so we decided to start doing sale-leasebacks with them. They would build the building, they would have a grand opening, we would buy it, do a 25-year bonded lease with them, and as soon as that happened, we would close the deals. Now, just to give you an idea of volume, from that point in 1988, 89, until now, we did over 150 stores with Walmart. We have been their largest landlord for probably 25 years. Well, back then, so why did we want to do this? Well, we thought that was very good real estate, great tenant. Even then, it was a great tenant. And so what we would do is we would buy the property. We would have the vote for the investors. They would all vote to put the property on the market and then exchange it into the Walmarts. Well, in some of those deals, when they put the properties on the market, the best they could do is sell it for the debt. And in some of them sold for a little bit more than the debt, but nowhere near what they had into it. So what we did is we put our own money into the deal, subsidized it, so that the investors would not lose any money, nor would they have any tax liability, and exchange them into these Walmarts. Now back then, today 16, 17 million doesn't sound like a lot of money, but back then was all the money in the world to us. And that's what we put into those deals. And to this day, we're pleased that at that time nobody had ever lost a dime with Inland. Well, that brought us into a whole new set of things. Number one, we thought that most people didn't like anything having to do with apartments or industrial or other aspects of real estate because everybody lost their money during that 86 to 1989. So we thought the best thing to do now is invest in vacant land. It was a white elephant. So if you can invest in vacant land at its absolute worst point in time, the future is yours. So we formed 3 land funds for about $110 million. And between 1989 and 1993, we started buying up tracts of land all around the Chicagoland areas. We concentrated going west to places like Kendall County, north to places like Kane County, McHenry County, Lake County, and we all knew where the traffic was going toward once the market gets better again. So that wasn't that big of a leap for us to do. And so we bought land. We bought it for all cash. And during the 90s, we would we would rezone it, we would cut it up and have it ready for builders. And the way we would rezone it is to make sure we had the option to do either commercial, residential, industrial, or manufacturing, just in case any one of those aspects of real estate got better faster. Well, throughout the 90s and the 2000s, the investors that invested in those land funds did very, very well. We got them all rezoned. We ran the farmland. There was enough income to pay all the taxes and everything, and thank God we did it all cash, so you didn't have a lender knocking on your door all the time to get paid, and sold them off piecemeal to developers as that went on. So that was one thing that happened after the tax law change. The other thing that happened was we started to gravitate toward retail. We gravitated toward retail instead of apartments. We had gotten to about 42,000 apartment units. And the reason why was because retail was giving off a better return. And so we decided, instead of living in partnerships, 1994-95, let's do a REIT. The first REIT was Inland Real Estate Corporation, and it started buying retail all around the Chicagoland area and the Twin Cities of Minneapolis, St. Paul. And during the 5 years, 95 to 2000, that entity, we raised all of the cash through the broker-dealers and financial planners that we've been dealing with for, 15 years. And we collected all the capital, bought all the properties, and that REIT then went on to the New York Stock Exchange in 2004, where we, instead of ringing the school bell, we rang the New York Stock Exchange bell. That was a great day. And then in 2000, we started the second REIT, and that was our Southeast REIT, Inland Retail Real Estate. And that one we bought retail going south through Florida all the way up the East Coast. Now that one, the first one was about $2 billion in assets. The second one was $4.4 billion in assets purchased, and then instead of going to the New York Stock Exchange, we got a better price from the market. We sold it to DDR for $6.2 billion, and the investors had a good time going to the bank. All of our stockholders did, and so did we. And so instead of going to the New York Stock Exchange, we sold it in 2007. Now I go back. In 2004, we started what was called Inland Western, but now that entity is on the New York Stock Exchange and is called Retail Properties of America, Inc. And in that, we bought properties west of the Mississippi and, in certain instances, east of the Mississippi, too. That entity grew to about $6.5 billion in assets and is now on the New York Stock Exchange. Now, it then brings us to 2000 and, I think it's 2007. We started Inland American, or 2007. Inland American, we decided, instead of just retail, why don't we see if we can buy properties with all of the education we've had in real estate and all the product types. So we said, we're going to make this REIT a diversified REIT. We're going to buy apartments, we're going to buy industrial, we're going to buy office, we're going to buy retail, and we're going to do student housing. We did all of that. And that REIT now is $11 billion in assets and hasn't gone to a liquidity event yet in the New York Stock Exchange, et cetera. And then in 2009, we did Inland Diversified, and Inland Diversified bought the same kinds of products but concentrated on retail, industrial, and office, and some apartments. And that one, now I think the directors now have hired some Wall Street finance people to talk about planning and maybe a liquidity event. And I think I covered all of the REITs. I think that is about it for our history. We manage all of our own assets. We always have. We never believed you could have another company manage your assets. They don't have the blood, sweat, and tears in it, et cetera. And to today, we've probably done about 600 different funds. And out of that, about 430 or 440 have gone full cycle, meaning we raised the money, we put the money into play by buying the assets, we ran the assets, and then we sold the assets. And in all of those 430 some odd funds that have gone full cycle, and not one of them, except one, has the investors not received total distributions equal to their total capital contributions. And no one has a record like that, nobody. And even that last one that we think is a loser, which was actually Retail Properties of America, their stock price has gone up 90% in the last year since it went on the New York Stock Exchange. So I think we're pretty close to being able to say 100% again, but we're not there yet.
Obviously, you're the one who does the acquisitions. Talk to me a little bit about how you size up a deal, what you typically look for. Tell me a little about your process when you're assessing an opportunity.
Well, I think the assessment of the property, I think it's the same thing whether it is an apartment building, whether it is a retail building, an office building, an industrial building. They're pretty much the same when it comes to some general things. One, do you like the area? You know, everyone says location, location. Well, what does that mean? Well, what it means is when you go out to a shopping center, you know, you drive up to it and it's a welcoming place to shop. You feel good about it. Well, to me, that's a good piece of property. That is a property which people would call a core property. You pull up to an apartment complex, and there's nothing that bothers you that wouldn't allow you to walk into the apartment complex. And then, once you walk into it, the hallways are pleasant, the environment is pleasant, you walk into the unit and, oh my, this is kind of cute. Well, these are the things that are simple, logical things that people should think about whenever they're buying anything. I don't care if they're buying their home or if they're buying an investment. And these are the same things that we look at, only on a much more sophisticated level, because now you have to drill down into each one of those assets and say, are these the proper tenants for the shopping center? Do they help each other, or do they fight with each other for the same consumer? You go to an apartment complex. What do the cars look like in the parking lot? First clue. They're kind of junky, take a walk. Unless you think you can redo that whole place and change the makeup of it, if you don't think you can do that, take a walk. Go to another one. It's these things that you have to drill down to. Now let's go drill down into the shopping centers a little bit more. In a large shopping center, you're going to have one or two good anchors. Usually the best is a grocery store. Why? Because once someone goes to a grocery store, it's usually once or twice a week. Well, not only do you go to that grocery store, but chances are 1 door down you're going to go to the cleaners. 2 doors down you might go to Sally Beauty to pick up something. 3 doors down you might go to Hallmark and pick up a card, unless you're going to email it, which I hate, because I want to keep my stores open. And so there's many different stores that will feed off of the same people that are going to that grocery store. Okay? Let's take a power center. You go to a power center. Are your 2 big anchors helping the smaller anchors? Do they work with one another? You could have a Target, which is an elephant, or you could have a Walmart, which is an elephant, which is going to take most of the customers. But you might have a Dick's Sporting Goods, a whole different atmosphere, a whole different reason why you would go there and buy a particular item as opposed to going to the Walmart or the Target. So those kinds of things work well with one another, and that's what you have to sit and make sure that that you feel good about, and that that's the kind of atmosphere you want in your shopping center.
So from start to finish, I saw your video. You seem to take pride in making decisions on whether to acquire an asset quickly and being able to give a prospective seller a fair price within a reasonable period of time. Start to finish on a typical deal, say someone brings you a grocery deal, how long does it take you to decide whether you want to buy or not?
Well, I can tell you that if someone brings me a grocery store deal, I would say in a few minutes I'd tell you yes or no if I want to go any further. After all, we've been doing this for 45 years. If I and my immediate staff don't know that right away, we should have been retired, or we should have been fired. Why do I say that? Certain grocery stores I won't touch. Certain areas I won't touch. Maybe they're just too green. The developments all stopped when 2009 hit, and maybe that is going to take years in order for it to get any better. Well, what does that mean? Well, you're not going to be able to keep the small stores along with the grocery store. I don't care if it's a Publix. I don't care if it's a Kroger's. So in that instance, I can say yes or no pretty darn quick. Now, if I say yes, well then I'd like to have all the numbers, all of the tenants' information regarding lease terms, etc., and I want to know if it's an older property, when was the last time you did the roof, etc. I want to know all of these things. You give me all of those things, and then I convert it, or I have one of my underwriters, like Warren. Warren's been with me for 35 years or more. Maybe it's only 38 years now. In any event, he'll put it on my form. I can see everything that's important to me, and I would say within just a couple of days, we can tell you whether or not we would buy it. Now, the next battle is, will that seller, come down to our purchase price? If he does, and we say yes, I will sign whatever the seller is comfortable with on a deal, from a 3-page letter agreement all the way to a 50-page contract that they wanted. I'll do either one. And once we're in due diligence, within 30 days, that deal is closed. I think the fastest deal we probably ever did was maybe 17 days, if I remember that, in my history. And the worst has been maybe a couple of years because of some seller problems.
Yeah.
But we don't give up.
So you're buying for these various REITs, or how do you kind of decide, do the REITs come to you and say, Joe, we need more Midwest office or more Southeast retail? How does that sort of play in?
Yeah, all of the above.
Okay.
We pretty much know what everybody wants and needs. As an example, if you're in the Chicagoland area, the property most likely will end up with Inland Real Estate Corporation. But let's say they don't want it. They don't either have the cash that time or for some reason they don't want it. If it's bad, it's not going to go anywhere in this company. Bad for whatever bad means. But if it's because they don't have the capital, then maybe Inland America might buy it. Maybe Inland Diversified might buy it. Maybe Inland Private Capital might buy it. So there are a lot of different pockets here. And because there are so many different pockets, it allows us to buy not only a lot of properties. So as an example, last year we bought $2.3 billion worth of real estate in 169 deals. And not only does it allow you to buy a lot of properties, it also allows you to buy many different categories in real estate, so that if one aspect of real estate is so doggone hot you don't like the cap rates, then concentrate over here and work on this one until this one gets too hot. And that's pretty much what we do.
Okay. So last 5 years have been challenging for real estate and financial markets. And real estate certainly has bounced back, and things are getting sort of back to normal now. But what have you learned from the last couple years? How have you changed? What lessons were learned?
The downturn of the economy for commercial real estate really started about January of 2009. In late 2007, lenders started defaulting on commitments. And in 2008, you pretty much saw the decline of the housing market, and you saw the bubble burst of all of those terrible, terrible loans they did on residential real estate to people who just could not possibly afford what others got them into. Shame on them. But it took about a year and a half to hit commercial real estate. And in the beginning of 2009, I remember saying around here, I'm not sure whether I'm more nervous for the Treasury bills I have, or I'm more nervous for my commercial real estate. But I said, this is the best time to buy that I've ever seen in my entire business lifetime. I had seen cap rates in early 2009 that looked the same as they were in the late 1990s. And I said, either we put all this money into play right now into real estate and enjoy what's going to happen in the future, because it will get better, or it won't matter whether or not you don't put the money in there, because if it gets any worse or stays this way forever, everybody is going to lose everything, including whatever they've saved, including whatever they've invested into. So we had about $1.5 billion or $1.8 billion in early 2009, and we started buying like crazy. And we were the only game in the U.S. We're literally the only buyer on deals. And so what had happened is several things in 2009. Sellers were coming to us, much like what happened in the 1990s, even passing up the brokerage community. Now, I don't necessarily like that, but I like the fact that we got the phone call. And so what they wanted was a sure deal, and they got it from Inland. Another thing happened. the brokers were coming to us saying, we can't get a listing on this deal, but we know this deal. Would you protect us? Absolutely, we always do that. And so we've gotten deals that way. So all through 2009, it was literally being in a candy store. I only wish there were more properties on the market. We couldn't find enough good deals to buy. In 2010, what happened was the first half was pretty much like 2009, but there were a lot of funds that started to raise big money waiting for a huge amount of bad debt to come to the market and a huge amount of not bad deals, much less as the bad owners having deals come to market. And I never believed that was going to happen. I always believed you take the bad deals today as fast as you can. Now, a bad deal to me was not that the property was in bad shape. It was the fact that the developer was either going bankrupt or couldn't possibly refinance the mortgage he had on it. Some other reason. The owner had the bad problems, not the property. And grab them as fast as you possibly can for the best price you can. And I know we were right. We were right all through 2009, 2010. 2011 started getting much healthier. And other REITs started getting in the marketplace, and the competition was at hand. And so instead of the cap rates being in the 9s, now a lot of people talked about, they bought cap rates for 10, 15, 20%. Okay, maybe they did. But most likely it was on a value-add deal where half of the center was busted out, etc. I can understand that. But I'm talking about good, solid real estate that was well occupied, etc. And with our underwriting, a 9% to us was most likely a 10% to somebody else. And so when those cap rates were 9s in the 2009s became high 8s in 2010, in 2011 they dropped all the way to the low 8s or 8. At the end of 2011, they've gotten into the 7s, and by 2013 now, you're into the high 6s on cap rates. And that's what has happened in commercial real estate. One of the reasons is because there's a heck of a lot of money out there. And the other reason is that more and more people have decided, I don't want to go through another 2009 again, and let's get out now while we can still either get back the money we had into it or save most of the money or maybe make a profit. Now, how did we change? Boy, we changed underwriting. We not only do, in shopping centers, not only do we figure who's ever vacant today, we're going to leave vacant forever in our underwriting, but then when you do the tenant interviews and you see tenants who you wonder how they're going to make it, period, you write them off and you put them in your vacancy factor also. Then there's tenants that if the rent was just a little lower, they could make it better. We write down the rents ourselves on our underwriting, and we put another category in there. And that's enough to make things awfully safe. One other thing. I don't ever want to say, let's do a 5-year loan again. Oh, God. Unless we're going to flip the deal within that 5-year period. In 2005, 2006, I regret ever agreeing to doing 5-year loans because we'd have never gone through all of the refinancing we had to do in 2009 and 2010 in that horrible market. Now, fortunately, J.P. Morgan chose Inland to do the first CMBS offering on the street on December 1st, 2009, and there hadn't been a CMBS deal done for 18 months before that, which really picked the market up. Certainly elevated our name in the business world, and we were able to do more and more financing after that. But boy, I don't want to go through that again. And I think that one of the things in the back of my mind always is, don't trust the market. Don't ever assume your real estate's going to go up, and don't ever assume that you're going to be able to refinance that debt if you do a short-term debt.
Inland historically has been a suburban company. There's kind of a lot of talk now that we're re-urbanizing again. There was a story in Cranes, right here in Chicago. The core downtown area has grown by about 20,000 people in the past 5 or 6 years, while the first ring suburbs, the DuPage counties, et cetera, have been lagging to some extent. How is Inland kind of reacting to that, or perhaps you disagree with that outlook that some folks have, that we're re-urbanizing again?
Well, let's look at the office buildings. I'm not a fan of office buildings, but in the office building market, I think that the urban areas, the real downtown urban areas, are getting healthier and healthier, at least for the time being. The suburban ones are getting less healthy. Now why don't I like office buildings? Well, in my pocket, I've got an iPhone, like everybody else has got. I could be in my house. I could be sitting on the beach in Florida doing my business off of my iPhone. I don't have to be in my office. And I think that's true of many, many, many employees in companies. And so I think that whether they've got an iPhone or an iPad mini or an iPad, or whether they have a laptop or whatever, they can do their business outside of that square footage they used to occupy in an office space. I think the suburban office space is going to be hit the hardest because of that. That's one of the reasons. When I look at an office building, I look at it and say, why would I want to rent there? What is the reason? Does it have underground parking? Yeah, that's pretty good. Am I on top of all the restaurants where I could just walk outside and go to them? Is there a health club facility in the building? There's a lot of things you have to look at to make sure that you believe you can keep that occupancy up as much as you possibly can. I'll give you an example of a building. Downtown Minneapolis, there's this big monolith black building, which was the start of the revitalization in the 70s and 80s of downtown Minneapolis. It's called the IDS building. Okay. My partner dragged me kicking and screaming to go look at that to buy. I didn't want to buy that big office building. You know, it's just a big mess. But what I realized was, when I saw that building and I saw the history of it, in 2001, 500,000 square feet was occupied by American Express. They vacated the entire, well, it's 1,400,000 feet. 500,000 square feet was them, and they vacated the whole doggone top section of the building. I mean, that caused a big problem. Then there was another tenant that was about 190,000 feet, went bankrupt. Well, what happened was the owner at that time had to redo what was involved in that whole building. What he redid was to put in tenants that were all smaller. Maybe they were 5,000, 10,000. The whole floor was only about 30,000, 35,000 square feet. So by the time I got to it, there was no tenant except for 2 or 3 that had up to 100,000 square feet. So nobody who left could really hurt you. Next thing I looked at, because there's multiple angles of the building, the way it was built, you literally had 8 corner offices on every floor. Now that's important to your occupancy, because you can give Joe a corner office, you can give Dan a corner office, you can give Bob a corner office, you can give Bob a corner. Then you go to the other corner, you can give Sam, you can give Sally, you can give Sue, you can give multiple corner offices to key employees. Next, I look at, there was a 600-car underground garage. Oh my. Now, Minneapolis gets kind of cold. I thought that was an asset. Then, Minneapolis has another virtue. The second floor of virtually all the buildings is connected by a walkway, heated, air-conditioned walkway. This building was the center of all 3 walkways that went for 5 miles in walking. And it also had the main domed outdoor, indoor area that the city had a lot of events at, right in this building. And finally, I had restaurants and commercial on the first 2 floors. There was a reason why people would want to rent in that building, and it is held true to that. Those are things you look at, those are things you won't see until you get there and you kind of smell the real estate. Yeah. But going back to the issue regarding, let's go to apartments now. Are apartments a big thing in let's say, downtown Chicago? They are. I don't happen to like it because they got the highest real estate tax bill in the doggone country. And you're going to have to push those rents like crazy in order to pay those taxes. It's unfortunate. I mean, Cook County has just got a terrible, terrible tax rate. And I literally shy away from that. The suburbs are still good, though. And there are many, many parts of the country that are still good. We have about 12 or 1,300 shopping centers and retail locations around the country. We got about 80 office buildings, about 70 industrial buildings. I think we got 17,000 hotel rooms, mostly Marriott and Hiltons. And I'm missing something. Maybe 10,000 apartment, student housing units around the country.
Are you shifting your mix, or are you buying more stuff in downtowns versus suburbs, or have not really changed your acquisition?
No, I don't think that has changed.
Okay.
We have all of the above.
Sure.
But if someone said to me, "Well, is there anything you're not buying?" I guess I'd say nursing homes. Don't like them. But otherwise, downtown versus suburbs, no. It's no different than we've done in the past.
So when you started buying up properties in the late 60s, commercial real estate is going through this transformation from entrepreneurial guys to more of a institutional market. How have you seen commercial real estate change in your experience, and where do you think we are in sort of the institutionalization of commercial real estate?
Well, one of the things that has changed in real estate over all of these years is you have less opportunities to sit across the table like you and I are doing right now and negotiate a deal, seller to buyer. I love that. I miss that in a lot of instances. I try to still do that, even if it has been the property has been brought to us through a brokerage house. I really try to get the brokerage house to put me together with the seller, because I think that both of you get a feel for one another, and it may not necessarily change the pricing, or then again it may change the pricing for the better. But once once you've come to an agreement, because you have faced off with one another, you have a much better feel for each other during the course of due diligence and closing. There's no longer a fear, or there's no longer this, hey, this guy offered me this, and what the heck is that? You don't have that kind of situation anymore. That can happen when you're doing emails back and forth. So that has really changed. Less and less contact between individuals occurs. And there are some brokers I've dealt with across the country for years. I have still not met them. But that's the way it happens. And that's true for whether it's my son Mark or whether it's Lou Quillisi or Matt Tice. The same thing happens. Unfortunately, you have to do a lot of things electronically or by phone, negotiating. So that's one of the biggest things. The second largest thing is where you used to get from the seller a one-page kind of write-up of what this property looks like on paper. Now you get these 30 and 40 and 50-page documents, including Argus runs, including every single intricacies of all the leases. It has become much more sophisticated. But then so have we. So I can deal with either one. Doesn't matter.
So is there still room in commercial real estate for the entrepreneur, or are we just becoming a REIT-driven market?
There is room, there's always room for an entrepreneur. I don't care what business it is in America. But when it comes to real estate, there is room, but the entrepreneurs got to realize that there's a long distance between the first smaller deal that you have the ability to buy and run yourself until you get to the really large deals. You really have to concentrate on the smaller deals, not necessarily smaller markets, just smaller deals. Guy buys a 2, 3 flat, 6 flat, 4 flat, 8 flat, whatever. Go where the population is, because at least you'll keep it occupied. And negotiate that deal and buy it and run it for a while. Then you can start going up a little bit bigger and then a little bit bigger. But it gets difficult for an entrepreneur to compete with companies like Inland when we want something to buy.
Yeah.
We just move faster.
Just going to run through a couple different asset classes. You've covered some of these, but just wanted your thoughts on each one. Let's talk about retail. How are retailers reinventing themselves to compete with the Amazons and so on? What are your thoughts on the outlook of retail and what kind of changes you're seeing? I know we're seeing smaller stores from some of the bigger retailers. Thoughts on that?
Well, retailers include a lot of different categories. The grocery store, the Dominick's, the Jewel Oscos, the Kroger's, the Publix, they all have competition. They have competition with the elephants like Walmart, superstores, Target, superstores, new grocery stores coming into the market, from Aldi's to Trader Joe's, etc. One of the things they have to do is dress themselves up better. They've got to look better when, like a person going out to a nice dinner. You better dress up nice. People will respect you more. Well, you dress up your store, and people will be welcomed more in your store. Number 2, you've got to give the freshest possible food items you can, laid out properly and friendly to the person shopping in those grocery stores. And thirdly, you have to give the best variety of each of the items that people want to buy and buy mostly in your store. And then finally, you're going to have to cut the prices and cut your profit margins down in order to compete with all of those competitors coming in town. Now, let's take other companies. First of all, I hate Amazon. I hate Kindles. Those companies and that product has wiped out so many jobs in America. And it's unfortunate. And we have been an advocate, not only politically, but also within the ICSC, to make sure that at least you have an even playing field with Amazon, that everyone pays the taxes they're supposed to pay wherever they are in the product they buy. And I think that's finally coming to fruition. But even that's not going to stop the flow of people purchasing things off of the phone or off of or by clicking the mouse on their computer. They call that the fairness, the Main Street Fairness Act, and I think it is fair. It's fair for everybody. It is the toughest thing to compete with those kinds of items I just mentioned. You saw all my Borders bookstores go under. Why? Certainly, the main reason was a Kindle. You saw the decline of the Circuit City stores. You saw, not only because Best Buy was better, but also because you could buy things over the internet, easier certainly. You saw the declines of all of these kinds of stores, and now those who are left have got to redo things inside their store which cause you to either have to come there or want to come there. One of the things is they've got to get the manufacturers to manufacture the item for the stores a little different than what you click on when you look at it on the internet. Now that would be a nice trick, because you'll never know if what you're buying at $29.95 on the internet is the same thing that's at the store at $29.95, because they have a little different description, or they have a little different, or they have a different name tag on it. You've got to do that. I think Target has started to do that with their manufacturers. Another thing is, let's take Best Buy. One of the interesting things I saw at Best Buy within the last several months was that they have a big section for all the phones. Well, they always had a big section for all the phones. So what the hell is the difference? Well, the difference is now that they have every single manufacturer of phones in the store. They have every single carriers represented, AT&T, Verizon, etc. They have every single plan that you could buy from all those carriers there, and nobody works on a commission. They just work on educating the public as to buy. You can't do that on the internet. Thank God. You have to go into the store, and you want to go into the store. You want to get an education on that. You could do that with so many different kinds of products. I don't care if it's the Garmins and those kinds of things. You could do that in a store, and where you cannot do that on the internet.
Well, it's like the Apple stores. And Apple's been a pioneer in that, where they're educating people about the brand. They're doing classes. It's a community.
They have it down pat, and they have one of the largest profit margins in the industry. I love it. I love it. They have a great product, and they certainly aren't as affected by the internet as others.
Let's talk about multifamily. What's your thoughts about multifamily today?
They're hot. They're hot as hell. I don't think I've ever seen apartments hotter in the 45 years I've been doing business. What does that mean? Everybody wants them. Well, what does that do? It usually raises the price and it lowers your cap rates. I'd say they're the lowest cap rates I've ever seen in my business career.
How low have they gotten in some of the hard houses?
If you're in Washington, D.C., if you're in New York somewhere, you're probably in the 4 cap rate range, somewhere in the 4s. If you're anywhere else that's healthy, you're in the low 5s to mid 5s. And the only way you would find one that would be a higher cap rate in the 6s is either you're lucky as heck, or you have to take over the seller's debt. And in most cases, that debt payment is higher than what you'd have to pay today if you put new debt on, which forces that price to be lower and the cap rate to be higher. Now, why is it so high? Well, I'm going to tell you that I'm not toot my horn, but I'm going to tell you in the spring of 2009, remember, we've always been in apartments. I talked to my key managers in apartments, and I said, so what's going on in our apartments? Are we losing tenants, et cetera? And they go, no, in this economy, we're shocked. The occupancy is getting better and better by the day. And the only way we're losing a tenant, because we always have these exit forms you fill out, exit interview, why did you leave our apartment building? You know, did you hate us? Did you leave for some other reason? And we saw that the only reason why people were leaving was because they were losing it. They had lost their job. Certainly it wasn't because they were buying houses like what was going on in 2005, 2006. No, it was because they were losing their job, or they had moved to another location far away. So I said to everybody, this is the time to buy apartments that work in our underwriting as fast as you can and as much as you possibly can, because you're going to see this not stopping. I don't see the housing market coming back for years. That's what I said in 2009, and I was right. And now what you have is you have a whole population of this generation, I think they call it Y. I'm not positive, or I don't know why they do call it that, but they're looking at all the things that happened to their parents in real estate, and they are in fact saying, gee, why don't we stay in apartments for a long time? After all, what's the use of buying a house? We might lose part of our investment. So there's a concern there. And it's keeping occupancy up, it's keeping rents up, and it's hot all around the country.
Yeah. Industrial.
Industrial's a bit scary. At the end of last year, I thought I saw warehouses filling up more and supplying, what do they call that in the industry, where you supply things the minute you need it?
Just in time.
Thank you very much. Just in time. I saw it, but now in the last couple of months, I'm seeing more and more vacancies in industrial. The jury's out on that. I'm not sure. But I am sure that you'd better own industrial with the highest ceilings you can, because you can accommodate so many different companies in the future if your guy leaves.
What's considered as high as possible?
My opinion is 28 to 32 feet is safe. Last year I bought a Siemens building in Arizona, and the one part of the building was 70 feet. And you go, my God, why was it 70 feet? Because they had these huge cranes which picked up the turbines and moved them from section to section. I don't know who's going to be able to use that afterwards, but certainly the rest of the building was 30 feet.
Hotels.
Well, if you bought hotels in 2005, 2006, you were flying. If you held them in the end of 2008, 2009, 2010, you saw the incomes drop like crazy. Now, I'll give you a general kind of view of this. We had, I don't know, maybe we had 12,000, 13,000 hotel rooms back in 2009. When we bought them, we were getting returns of anywhere from 8 to 12% on our hotels. 2009 was the worst year for hotels because people started to stop traveling, business people started traveling, etc. And those incomes dropped off. Now, ours probably dropped down as low as maybe 2 or 3% we were getting on a return, where a lot of companies had negatives and lost a lot of hotels. Now what we're seeing is about a 60% increase from the low, so that we're back up to a pretty good return, and we think this is going to get better and better.
60% return.
Back up. In other words, if we were getting 8 to 12,
gotcha,
and it got all the way down to 2 or 3, so maybe we're 6, 7, 5, 6, 7% today. And
is that a cash basis?
Oh yeah, cash on cash basis.
Okay.
That's what I'm talking about.
Gotcha.
And so that's better. And we are concentrating, mostly, as I said before, about half of our rooms are Marriotts, about half of them are Hiltons, and some Hyatts. Is
there and a lot of people would have expected maybe a shift towards more moderate income brands, given corporations cutting costs. Have you seen that, or is it still people are staying at the most expensive properties in the market?
We thought we were going to see that.
Yeah.
And we have the gamut from the limited service all the way up to you can have a wedding and you can have a convention there.
Yeah.
There was some turning away of business people from things like the Ritz-Carltons around the country and the absolute classiest. But we did not see people who normally would go into an upscale Marriott or an upscale Hilton go down all the way to the limiteds as much as we thought we were going to. And so now we are actually buying more.
All right. So back to medical office. What are your thoughts on medical office?
A medical office, I happen to like it a lot. However, my due diligence people don't. Now, what does that all mean? Well, everyone's afraid of what the Obama changes to the entire industry, how it's going to affect, starting next year, all of these doctors, the medical practices, what they own, what they control, etc. I'm not sure I'm that nervous about it, but everybody else is, so we haven't really bought many. Now, what do I like? Well, if you've got a medical office building on the grounds of a hospital, I don't know how you miss. The negative to that is, most likely you will not own the ground. The hospital will own the ground. Well, so you bought air. How long did you buy the air? 50 years? 80 years? I might still be here. But still in all, you could lose the building at the end of the term of the ground lease. Well, let's go to who's in that office building, and it's not on the grounds of the hospital. Maybe it's across the street. Maybe it's down the block. If you've got doctors' offices in that building, and the first floor you have outpatient surgical, it's hard to finance. I know it's amazing to hear, but it's hard to finance. I found that out.
Why is that?
I think it's because of the amount of square foot dollars that you have to pay for that particular space, the rent they're paying, and the fact that literally it might be halted. If one of those doctor's offices owns that outpatient facility, I don't think you can do that anymore. You can't control the ultimate place that you send that patient to and make money off of them. I don't even think you can own all the machines anymore, but I'm not positive. Okay, so that's one thing. The second thing is, I had an office, I had medical facilities, which I thought were pretty good. Went through all of them, went through all the offices, etc. And what it was a doctor's group made up of many different sub-doctors groups. Like, let's say, for instance, it was called, Medical A. And Medical A had Dr. Janus, who had his heart patient practice. And then there was, and he had multiple doctors, big practices. Then you had Dr. Sally, and she had women's hospital, women's medical facilities, and so on. And they were all grouped into one building, and the lease came from what do they call it, Medical X or Medical A or something, whatever the main company was. And all of those doctors kind of fed off of one another. In other words, there was some synergism in that building. And that sounded pretty good to me. But the bad thing is, because that lease was one lease and it came due at one time, theoretically, the whole building could be vacated. Or, theoretically, the medical group A had me by the throat and said, reduce my rent in half or all these doctors are going. So that's another thing you have to look at when you're looking at medical. Now, if you've got a hospital that leases the entire building from you, and then they have their different medical practices that work out of that particular hospital in your building, you have the same problem, but maybe it's a little bit better because the health ratio of the tenant is better than the medical group that you had before, and maybe the term of the lease is longer, 15, 20 years, maybe. There's all these different things that you have to look at in medical, but generally I happen to like it. It's just that a lot of my staff doesn't.
Student housing.
I'm not an expert in student housing, but I got to tell you that the kinds of student housing we have You would live in there. I'd live in there. They're just amazing. They're just pleasant places to go to after you've gone to your class to go and study. And that is certainly the way the entire world is going on student housing. You're not going down the hall and sharing the bathroom facilities and the showers with a bunch of people. I mean, maybe some guys would like that. I wouldn't. I'd rather be by myself. And the same thing with ladies. So that whole business is incredibly good. And if you're on campus, wow, it's great. If you're just off campus, you'd better have transportation all the time going back and forth from your building to the campus.
Land.
Vacant land, it's still an opportunity to buy, especially if it's already rezoned and cut up into home lots, etc., and you're in a real growth area. I think you could buy those from lenders. I ain't going to say dirt cheap. Oh yeah, I said it. You can buy them for probably a price that you would have bought it for maybe in the 90s.
Yeah. Thoughts on each of these regions? Maybe if you want to break down some of the cities within there. Let's talk about the Midwest. Kind of your outlook.
Well, given the fact that I've got 150 shopping centers I could drive to right now in the Chicagoland area, and we've got properties all through Wisconsin and Minneapolis and Indiana, I think we like we like the Midwest. It's it hasn't had as many spikes up and down as other areas have had in the country. But then you go to, let's say, Texas, and you look at Dallas and you look at Houston, which had a horrible problem at the end of the 80s and the beginning of the 90s. That, I mean, almost literally hasn't been affected by the economic downturn, even in the housing market, as the rest of the country has. Dallas and Houston are just solid. We probably have, I'll bet, between 20 and 25,000 feet.
How about Atlanta and South Florida?
Well, we used to like Atlanta a lot. We were the largest landlord in Atlanta up until we sold that REIT to DDR in 2007. I'm glad I wasn't there during 2009 and 2010. However, I will tell you an interesting little story. 2 years ago, my son Mark bought 16 shopping centers back from DDR, which we originally owned at one time. But they had done a deal with teachers, a retirement system, and teachers wanted out. And so those 16 centers, of which a lot were in Atlanta, he bought back at I think it was about $150 million less than we had sold them in that whole REIT to DDR for. So I thought that was kind of an interesting turn of events, given what happened from 2007 all the way to 2000. I think it was 2011 he did that deal. So that was an interesting sign of the times. Right now, Atlanta, yeah, I like Atlanta. It just depends. You know, it depends on so many different things. Who are your tenants? Yeah. You know, are they going to last? You know, are you in a really good area of Atlanta? Are you an area that's struggling? Are you in an area that's got so many vacancies that any tenant could go anywhere for less rent? Lots of things you have to think about.
South Florida?
It was cold as anything up until about a year to 2 years ago, and now it's hot again. I don't mean climate. I mean it's coming back. I never lost interest in South Florida at all. Retail, I don't care if you had condos there. I don't care what you had there. I never lost faith in that, because as fast as that went down, I was pretty sure it was going to go back up as it got healthier and healthier, and you're certainly seeing that now.
Let's talk about the Northeast, the Washington, D.C.s, the New Yorks, the Bostons.
Untouchable.
Yeah.
Even though we buy there, there's in most cases untouchable. Now,
when you say untouchable,
last year,
when you say untouchable, you mean
cap rate wise,
okay,
because they're low. Now, we were fortunate last year. There was a couple of firsts that went on at Inland in 2013, and one of those was we bought the largest power center ever in the largest purchase price ever in the suburbs of New York. We did the White Plains deal. It had Target, it had the ShopRite, it had Barnes & Noble, and many, many other tenants. That was pretty interesting. You know, it's a nice thing to know. And another thing, it wasn't one of the first, but we also bought the large Walmart Lowe's brand new center in Bayonne, New Jersey, right across from Staten Island, across the water from Staten Island. I think that was good. We did many of the A&P stores, Pathmart stores in Jersey and New York itself. All of them that we did all had sales per square foot of $650 to $950 a foot. So we took the best that we could find. I like the Northeast. We did an apartment complex in Boston. We've done a lot of things throughout the East, but it's tough to find.
Let's go out west. Certainly Phoenix and Las Vegas got hit pretty hard. Started to bounce back. Talk about those markets, and then maybe the core LA, San Francisco.
Okay, this is almost like a setup because you walked into the second first that Inland did in 2013. So the first one was the largest sale of a center in the suburbs of New York. The second was the largest shopping center purchase, not only in total square footage, but also in purchase price in Las Vegas. We went back 10 years in the records. We couldn't go back past 10 years. It's the largest deal in the last 10 years at least, and maybe even longer. It was 1,750,000 square feet. It was 6 shopping centers. It was $296 million, and your biggest tenants were Walmart, Sam's Club, Home Depot, Lowe's, and a bunch of other tenants. Why did we buy it? Because most people thought just like you just did when you asked me the question, well, that market got beat up like heck. Yes, the housing market got beat up like heck. Yes, the casinos got beat up like heck. But the shopping centers that were in communities where you still had to buy things were still healthy, didn't tank, and not only didn't they tank, you saw that even the small tenants were renewing their leases, which was a big thing, and 2, they were actually increasing slightly their rents. And some of the junior anchors, literally while we were in due diligence on the properties, renewed their leases at higher rents. Many areas of Phoenix are like that. coming back.
And finally, have you bought anything outside of the U.S.?
The only time I ever bought anything outside the U.S. was when I did a sale leaseback with American Express on 8 of their corporate headquarters around the country. One of them was in Toronto, suburb of Toronto. And I was scared to death of buying something in another country. I have no idea how to do it. I certainly didn't want Canadian dollars. Not that I don't like Canadian dollars. I just didn't know how they would match up to American dollars year after year, month after month. So what I did was, after spending thousands of dollars in legal fees trying to figure it out, what I did was I got an American corporation on the lease, and I got the rent paid in American dollars. But other than that, it's the only thing I ever bought across the borders.
Last question. What's your advice for someone looking to get into commercial real estate today?
Find a partner. I don't mean a money partner. I mean a good friend, a good person you can trust. I'm telling you that if it wasn't the four of us together at the beginning, who else would you ask questions to? Who else would you possibly on the job learn from? And literally we taught each other. And we still do. We still bounce things off of one another when it comes to the major decisions. You've got to be able to do that. You've got to have somebody with you, I think, when you're doing something like this. Someone you could trust. In all these years, the four of us never had a major battle with one another. I'm the most volatile. I'll yell, scream, I'll pound the table, I'll swear, etc. And it goes out of my system, and it's gone in 10 minutes. But we all do respect one another. We all listen to one another. You need someone to do that. You need somebody to rely on when you're unsure of what you're doing. That's the first thing. That's what I believe. And then second of all, start small with something you understand or certainly are learning the best about, and stick to it for a while. Don't switch gears unless certainly the first one failed.
Yeah.
And what I mean by that is, if you're going to go into the apartments, then go buy an apartment building. Go investigate it. Go do everything you have to do. Once you get it, run it for a while, and unless you've made a major mistake, stick to that product type.
Yeah. Well, this has been great. Thank you so much for your time this morning.
You're welcome.
And I think we all learned an awful lot, and appreciate your candor and experience. Thank you, Joe.
You're welcome.